Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, Trump's $1.3 trillion climate deregulation savings claim is contradicted by the EPA's own data, revealing a net loss and risking sticky inflation. So we'll discuss why this policy's official math points to a net loss and what it means for US automakers facing an investment cliff. Second, a 46% UK minimum wage hike is linked to soaring youth unemployment by a Bowie hawk, threatening to keep interest rates higher for longer. In this episode, we'll break down this direct challenge to government policy and what it signals for the Bank of England's future interest rate path. Third, White House advisor demands big tech pay for its AI energy boom, creating a Navarro Put that puts a ceiling on tech stock valuations. Today, we'll take a closer look at this clash between Washington and Silicon Valley and its implications for future AI investment and the tech race with China. The story today begins with a number that seems almost too good to be true. The Trump administration is touting a massive $1.3 trillion in savings from its new climate deregulation plan. But a deep dive into their own official report reveals a jaw-dropping contradiction. The EPA's own regulatory analysis shows that while the plan might save $1.1 trillion from cheaper vehicles and another $200 billion from fewer EV purchases, it will simultaneously rack up $1.5 trillion in new costs. That's from increased fuel purchases, more vehicle repairs, and higher insurance premiums. And the implications here go far beyond your personal budget. The key is that higher, more volatile spending on fuel for millions of households can create what economists call sticky inflation. This erodes the real disposable income of families and complicates the Federal Reserve's efforts to keep prices stable. So a policy designed to be a tailwind could paradoxically become a headwind for the entire economy. The net result, according to their own math, is a massive loss, not a gain. So how is the savings claim being justified? The report points to a best case scenario assuming severely low fuel prices. This is actually a classic example of what some analysts call model-based policymaking. Government agencies use a formal process called a regulatory impact analysis, or RIA, to weigh the costs and benefits of a new rule. The Energy Information Administration, or EIA, provides multiple scenarios, high, low, and reference cases for oil prices. By exclusively picking the most optimistic low-price scenario, the analysis can be engineered to support a predetermined narrative. This practice undermines the credibility of government economic analysis and increases uncertainty for long-term investments. Critics, however, are firing back. Kathy Harris of the Natural Resources Defense Council calls this scenario not really realistic and went further, stating they're cooking the books here. But that's not the whole picture. The real turning point is buried deeper in the same analysis, a projection that directly contradicts promises of lower gas prices. The report shows that eliminating greenhouse gas standards will actually increase gasoline prices by about 75 cents per gallon by 2050. That's a potential 29% price hike compared to keeping current policies. What's truly remarkable here is how this threatens to reverse decades of progress on American energy independence. Thanks to improved fuel efficiency and a surge in domestic production, the US successfully transitioned from being a massive net importer of petroleum to a net exporter in recent years. This was a huge strategic win, insulating the economy from global oil price shocks. A policy that increases domestic fuel consumption risks undoing that progress, tying US economic stability more tightly to volatile global energy markets. This all happens before even considering the massive social and climate costs, which one advocacy group projects could hit an astronomical $4.7 trillion. This brings us to a crucial metric economists use, the social cost of carbon, or SCC. It's an estimate of the future economic damage to health, agriculture, and property from flood risk caused by emitting 1 extra tonne of carbon today. By excluding this from the main calculation, the analysis ignores a massive hidden fiscal risk. The White House's own budget office has previously estimated that climate-related damages could cost the US up to $2 trillion annually by the end of the century. Ignoring these costs is like having a massive unfunded national liability that future taxpayers will have to bear. In a stunning contradiction, while the headline touts a $1 trillion saving, the administration's own data points to higher costs at the pump and a net financial loss for the country. The real drama now shifts to the auto industry. The key focal point will be their reaction. US automakers have already committed billions of dollars to developing electric vehicles and their battery supply chains based on the previous stricter standards. This sudden policy reversal creates what's called an investment cliff. They now face major uncertainty and production inefficiencies, trying to build cars for two different regulatory worlds, a looser one in the US and a stricter one globally. This uncertainty could harm their stock performance and, in the long run, risk ceding EV market leadership to Chinese and European rivals who benefit from a more consistent and predictable policy environment. Speaking of policies creating unexpected economic headwinds, let's jump across the pond to the UK, where a well-intentioned policy is facing some serious scrutiny. A massive 46% wage hike for Britain's youngest workers, but a Bank of England policymaker is now flagging a devastating side effect. Youth unemployment in the UK is surging. For workers aged 18 to 24, the jobless rate has jumped from 10.2% to 13.7% in just 3 years. Interestingly enough, the most recent data paints an even starker picture. The latest figures show the youth unemployment rate has now hit 15.9%, the highest level since 2020. At the same time, the number of young people not in education, employment, or training, what experts call NEET, has climbed to its highest point in over a decade. This is the worrying backdrop for our story today. Now, Bank of England policymaker Catherine Mann is drawing a direct line between that rising unemployment and the country's aggressive minimum wage increases. While the minimum wage for workers aged 18 to 20 was hiked by 46%, the rate for 21 to 22-year-olds was simultaneously boosted by 33%. Mann is pushing back against the idea that this is just a sign of a wider labour market downturn. Instead, she is pointing the finger directly at the wage policy itself. The core economic theory here suggests there's a tipping point. If the wage floor is raised too quickly, it can make hiring young, less experienced workers too expensive for businesses, especially in labour-intensive sectors like hospitality and retail. These companies may then choose to reduce staff hours, freeze hiring, or even replace human workers with automation. Essentially, the cost of labour starts to outweigh the value a new employee can produce, leading to what economists call a disemployment effect. Her assessment is blunt. She argues that the rapid accumulation of wage hikes has, in her words, been manifested in unemployment for that category of workers. She then adds a stark conclusion, very unfortunate, but it is true. It is a fact. This isn't just a casual observation. It's a direct challenge from a key monetary policy official to a central government initiative. To really grasp the weight of this statement, you have to know who Catherine Mann is. She's known as a hawk on the Bank of England's Monetary Policy Committee, meaning she tends to favour higher interest rates to fight inflation. By arguing that youth unemployment is a specific side effect of wage policy and not a sign of a weakening overall economy, she is building a case for the central bank to ignore this data point. This allows her to continue focusing on what she sees as the bigger threat, strong wage growth among core workers driving inflation. If her view prevails, it provides a rationale for the Bank of England to keep interest rates higher for longer, which directly impacts borrowing costs for mortgages, loans and businesses. The situation becomes even more intense considering the British government has openly stated its goal to continue raising the minimum wage for younger workers to bring it in line with the national living wage for older employees. When we place the UK strategy alongside many of its European counterparts, the contrast becomes clear. Countries like Germany and the Netherlands, for example, have tiered systems with lower minimum wages or structured apprenticeship pay for younger workers. The goal there is to encourage businesses to hire and train young people without the full cost burden of an adult wage. This makes the UK's policy a kind of large-scale economic experiment. The world is watching to see if this approach will lead to higher structural youth unemployment compared to its neighbours. This places a major policy meant to help young people directly in the crosshairs. A top economic official has now linked rising wages directly to rising unemployment for the very group it was designed to support, creating a significant economic and political dilemma. So, a couple of things to keep an eye on. First, watch those service sectors like retail and hospitality. The rising labour costs could trigger a wave of investment in automation and consolidation, which might permanently shrink the pool of available entry-level jobs for young people. Second, and most importantly for the markets, is whether other Bank of England officials will adopt Mann's view. If the central bank collectively decides to treat youth unemployment as a policy distortion rather than a sign of economic weakness, it signals that their fight against inflation is far from over and higher interest rates could persist even as parts of the economy cool down. We were just talking about the Bank of England's battle with inflation, and that brings us to another more modern source of price pressure, the AI boom. The most unexpected news at the intersection of tech and politics today has to be the blunt message a top White House advisor just delivered to big tech. Trade advisor Peter Navarro said all of these data center builders, Meta on down, need to pay for all of the costs. We force them to internalize the cost. So what does internalizing the cost actually mean? It's an economic term for forcing a company to pay for the negative side effects of its business that society would otherwise have to bear. In this case, the side effect is the massive strain that new data centers put on the national power grid. This is a direct shot at tech giants like Meta, Microsoft, and Amazon, whose massive data centers are being blamed for soaring energy costs. Here's where it gets interesting. The sheer scale of this new demand is something that's easy to underestimate. The AI boom is creating an urgent, almost insatiable need for electricity. The US Energy Information Administration projects this will lead to the strongest sustained growth in electricity use since the year 2000. To meet this sudden surge, the grid is turning back to what's available right now. Natural gas. This is a huge challenge to the green energy transition and the ESG commitments many of these tech companies have made. The core of the issue is a number that hits every American household. Electricity prices spiked 6.9% year over year in 2025, and there's little sign of relief. The White House is framing this as a battle for affordability, directly linking the tech industry's power consumption to rising utility bills for consumers. However, if you zoom out, you'll see another layer to this. A major economic trade-off. While forcing tech companies to pay for new power plants might offer short-term relief on your electricity bill, it could also slow down the very AI development that promises huge productivity gains for the entire economy. After all, these AI-driven gains are a powerful force against long-term inflation. So we're looking at a classic policy dilemma, a popular short-term fix versus a crucial long-term economic goal. But this is more than just an economic policy debate. It's a high-stakes political conflict unfolding ahead of the 2026 midterm elections. The administration is signaling it will use its full force of power to make tech companies pay for investors. This is where a new term is entering the conversation. The Navarro Put. A put is a financial tool that sets a price ceiling. In this case, the threat of government action is effectively putting a ceiling on how much big tech can invest in the AI infrastructure boom. This introduces a major political risk into the valuations of hyperscalers like Microsoft and Amazon, and by extension, their suppliers like Nvidia. Their future growth plans are now facing a new, unpredictable variable, Washington. The threat is already becoming action. The White House and several states have signed a pact demanding that big tech companies finance $15 billion in new power plants to support their own operations. The pact specifically targets PJM Interconnection, the grid operator for data center heavy regions like Northern Virginia. In response, a Meta spokesperson stated the company already pays the full cost for its energy and for new local infrastructure. The battle lines are being drawn. You know, the tech industry's response might be more radical than just paying up. The industry may be pivoting from being just energy consumers to becoming energy producers. Think about it. Amazon saw a problem with logistics and built its own global delivery network. Now, facing an energy bottleneck, we see Amazon Web Services moving to co-develop its own nuclear power facilities using advanced small modular reactors, or SMRs. This move blurs the lines between tech and utilities, creating a new kind of vertically integrated giant. Adding to the pressure, President Trump announced on Truth Social that he struck a deal with Microsoft to ensure that Americans don't pick up the tab for their power consumption. Shortly after, Microsoft pledged not to raise utility costs near its data centers and to replenish the water they use. The era of big tech's unchecked expansion, fueled by seemingly limitless and cheap power, is now facing a direct and powerful challenge from Washington. For our listeners in China, this has another layer of significance. By raising the cost of building and running AI infrastructure in the United States, this policy could unintentionally slow the American AI build-out. By comparison, electricity costs in China are significantly lower, averaging around 8 cents per kilowatt hour versus 18 cents in the US. This cost advantage, combined with a national strategy to power new data centers with green energy, means that a policy designed to solve a domestic US problem could inadvertently shift the competitive balance in the global AI race. The collision between the government's political will and the tech industry's operational needs is set to define who really pays for the future of artificial intelligence. So, how will we know which way this is heading? The key indicators to watch are the quarterly capital expenditure reports from companies like Microsoft, Amazon, and Meta. Any downward revision in their spending plans will be a major signal. Also, keep an eye on announcements for new energy projects, not just from utility companies, but from the tech giants themselves. These developments will tell us who is really shaping the future of our digital world.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.